What's up, everybody? Welcome to another episode of Swan Signal Live. I'm your host, Sam Callahan, Senior Analyst at Swan Bitcoin. Before we get into the show, I want to announce our sponsors. It is Cloaked Wireless. They provide the best protection against SIM swap attacks, which are a big problem, not just in the Bitcoin community, but more broadly. They are a privacy-focused provider where you can pay with Bitcoin, whether it's to secure your primary phone number or just a low-cost secondary secure SIM. Everyone should protect themselves from SIM swaps attacks by using Cloaked Wireless. So you can use the discount code SWAN at checkout for 25% off of your first month's service. So security is important, especially when we get into this bull market. So check out Cloaked Wireless. And then Pacific Bitcoin. Pacific Bitcoin is the festival that we put on in October in beautiful Santa Monica. If you use the promo code SIGNAL, you can get 10% off. And if you use Bitcoin, you get an additional 21% off. So go check it out at pacificbitcoin.com. For this show, we got a returning guest. He's a fan favorite. He is Swan CIO and head of mining, Rapha Zagury. So let's just get him in and get into things. Welcome back onto Swan Signal, Rapha.
What's up, Sam? Great to be back here. You know, always good to be here on the show. And let's get going.
Yeah, so, I mean, there's been a lot of developments since you've been on. I mean, we've seen, for one, this kind of shift in the sentiment in Washington, D.C., I would say, which, we've had multiple pieces of legislation get passed through the House and the Senate. And then we had the approval of the spot Ethereum ETFs, which kind of shocked a lot of people. But you wrote this piece and you actually think it's pretty bullish for Bitcoin. So let's start there. Like, what's your overall take on this shift in sentiment, and how is it bullish for Bitcoin?
Yeah, first of all, everything is bullish for Bitcoin, right? But in this specific case, I think I'll tell you, like, the number one question that we usually get from investors, right, or used to get from investors, is getting a little bit less, but is our government's going to ban it, right? So you start talking about Bitcoin, the asset, they understand the asset, they understand the returns, they may even understand the fundamentals, but when they get to the end, the inevitable conclusion is, listen, if this is as good as you're saying as a store of value, it definitely means, it could be a risk for the traditional system, and there's absolutely no way governments are going to allow it, right? And I think the recent developments, what we're seeing is that governments are not only allowing it, they're gradually embracing it. It's a big part of the political game theory as well. One of the things I put down on this thread is a quote by Thomas Sowell, right? That says that the first lesson of economics is scarcity, and there's never enough of anything to fully satisfy everyone, right? But then the first lesson in politics is to ignore completely the first lesson of economics. And I think this is exactly where Bitcoin meets politics, right? They had initially completely ignored the value of scarcity in Bitcoin. But there's something that they value more than scarcity, which is votes. And it's very clear that the Bitcoin electorate is very vocal, very opinionated, very strong, and there's this funny thing about the number go up that actually makes them very wealthy. So they are going to tilt the scales, and they are tilting the scales, and I think politicians are starting to listen. Let's go back 4 years ago, one cycle ago, and if we mentioned to anybody that the politicians were going to be debating about Bitcoin, and there's going to be one party that is pro Bitcoin, and actually a presidential candidate is going to be talking, people would just say, you're out of your mind. That's never going to happen, right? They don't need to go that far. 6 months ago, if you saw a video of Trump like the one we just that he just recorded, people would just say that's a deep fake. Absolutely no way that and it did happen, right? So I think there's a very clear shift in sentiment, regardless of the Biden veto at the end of the day. That doesn't matter too much. The fact is, it's becoming more and more clear that the risk of Bitcoin being banned by government, it's getting lower and lower by the day. I personally think right now it's that risk is pretty much non-existent. Or at least very, very small. And I think this is one of the biggest reasons why I think it's very, very bullish to Bitcoin. But there's more to that, right, Sam? Because if you think about it, like the whole process of approval, you mentioned the Ethereum ETF, right? it's another display, I think, of how the political system is broken and needs to be completely redone, right? Take the SEC. If we go back to the Securities Act of 33 and 34, right, when the SEC was created, the main purpose of the SEC was disclosure. So it wasn't to protect investors against new investors, or select what's a good investment or a bad investment for investors. Quite the contrary, it's just disclosure, and that's the way it should be, because what is a good investment for me may not be a good investment for you, may not be a good investment for other investors, right? It should all be taken into the consideration of the risk appetite of the investor, the investment horizon, what other assets they have, right, where they are located. There's a series, I think, of qualifications and characteristics that you need to take into account. And the fact that the SEC is denying people of getting access to ETFs and to at the end of the day, just getting access to Bitcoin, right? Just mind-boggling. Their whole purpose should be disclosure. And this is where I think they're still failing, because if we look, the fact that the Ethereum ETF was approved, which, by the way, I think it should have been approved, just like the Bitcoin ETF, right? People should have access to the investment vehicles, but they should also have proper disclosure, right? And the SEC did nothing. It actually, I think it did a disservice to the investment community by trying, or I don't think they tried, but they ended up putting Bitcoin and Ethereum in similar levels, when in fact they're very, very different assets, right? They're both digital, but that's where it stops, right? Ethereum does, if Bitcoin, as we were talking about, has full predictability in monetary policy. If we think about store of value, I don't think there's competition. I think it's even near to having any competition in any other altcoins. And again, the SEC doesn't disclose and doesn't even mention any of that, right? And I think that's the big failure in this cycle that very few people are talking about.
Yeah, I mean, I kind of agree with you in terms of, investors should have access to investment vehicles. And it was interesting when you compare when the SEC approved the Bitcoin ETFs versus the Ethereum ETFs, there was like zero comments from any of the commissioners on this approval compared to the Bitcoin ETFs, where Gensler came out with a whole letter basically saying why they did it. And, this isn't saying that you should invest in Bitcoin. They made this whole spectacle out of it, but there was nothing, complete silence with these Ethereum ETFs. I mean, were you surprised by that?
Super odd, right? Yeah, of course I was surprised. And it goes back to my point, right? If you want to do proper disclosure, right, which they should, the disclosure on Bitcoin, I think, was okay. The people should know it's a volatile asset, right? We talk about this every day, right? That if you're going to buy Bitcoin, you better be ready for the volatility, right? And volatility, it's a feature, not a bug. It just means that we're early, but it's going to be there, and you have to buy it with a time horizon that it's in our view, at least 4, even more years, so you can sustain a full cycle, right? Ideally, it's a 10-year asset, and that's the way investors should be thinking about. And that kind of disclosure, I think it's healthy. It's healthy for Bitcoin also, because if you don't disclose that, right, people are, and we've seen that, right? I've seen that with friends, with family in previous cycles, where they buy and then they see the first draw and they get out, right? And they get out at the worst time possible, because they were just not prepared for the volatility, right? Now, when turning to Ethereum, they should have mentioned, all the issues that Ethereum has, which is, a very unstable, unpredictable monetary policy, has changed several times. I posted on that same tweet thread, a series, and it's even incomplete, but a series of changes in Bitcoin in Ethereum's monetary policy, right? So they're like, I don't know, 6 or 7 of them that happened a long time. And then on the next column is the changes in Bitcoin monetary policy, and it's just an empty column. And it is going to continue to be that way for many reasons tied to game theory. And I think it's not going to happen, at least in monetary policy. It's not going to happen in Bitcoin, because the purpose of Bitcoin is not to be a world computer, and Ethereum is not even that, right? Or the birthplace for a lot of the altcoins. the whole purpose of Bitcoin should be the store of value, should be the best savings technology that was ever invented, and that can store the fruits of our labor for a very long period of time, without any intervention from anybody at their whim, right?
Yeah, I think that's going to be the key point to get through with our education efforts and really Bitcoin. I think that we're going to have to teach people like the differences once again. But they really are just different on every level. And Bitcoin has those properties that allow it to be a good store of value. You brought up the changes to Ethereum's monetary policy. And that's such a key point because even after the merge, which changed everything about it, they recently just had another upgrade, and it changed the annual issuance rate again, and now it's inflationary. One of the big narratives was that it was like ultrasound hard money because it was deflationary, but they just made another change, and it's actually been inflationary the last couple months. And now they're actually proposing another thing about changing the issuance rate again. And so it just goes to show it doesn't really matter like what those changes are. It's the fact that it is changing. That is the key point, and that's the big difference between Bitcoin, right?
But Sam, in situations like this, I always try to think about, put myself in the shoes of the investors, right? And I understand why people are attracted to Ethereum at first glance, right? Because they walk into a world like this is a complete new world for them. So if you're talking about, a traditional investor, and now again with institutions, we are going to go through this. It's going to be frustrating, and I think it's our job to try to point these risks out to people. Is that they invest in Bitcoin. And the same way they are used to the traditional system where they're going to buy a stock and they're like, okay, so now I bought Apple. So what's the next step? Oh, I should buy Google. I should buy Amazon. I should diversify my portfolio. And with that, try to put my money to work in different places so I can kind of like capture, I increase my chances of capturing some of the winners. And that works when you're talking about companies, that works when you're talking about indices, that works, that even works a little bit less, but it works when you're talking about bonds, it works when you're talking about real estate, it works when you're talking about a lot of traditional assets. It doesn't work when you're talking about the base layer, monetary assets that we would have, right? If you think about one of the challenges we have with fiat money is the fact that, if you think about dollars, right? Dollars should be a reference point. It should be a reference price for everything else, right? By the way, just to go back 1 second, and I ask this a lot, like a lot of our investors, particularly the institutions in the US, they'll come to you, they say, yeah, but I should diversify, I should buy other companies. And then very quickly, you should just turn to their portfolio, and their portfolio top to bottom, with a very, very few exceptions, 100% dollar base, right? So they have not diversified their dollar exposure. And when you ask them that question, right, they say, oh no, but the dollar is the monetary base layer of the world, right? And this is exactly the bet of Bitcoin, is that it's going to replace, initially not 100%, but partially it's going to replace the dollar. So there's no point to diversifying that. And that was very well put by an economist many years ago, Grisham's. And there's the Grisham's law that says that investment, this is not a process where there are several winners. It's a process that ultimately winner takes most of it, winner takes all, right? Because if you are an economic agent, let's say the fiat debasement continues, and you have two options to put your money. I'll tell you this, like if you live in Brazil and you have two options, I gave the option to the whole population in Brazil. I said, listen, today you have to choose. You're either going to put 100% of your assets in Brazilian reais, or you're going to put 100% of your assets in Bitcoin, right? Vast majority of, if they put a gun on their head, say you got to decide this today, vast majority would decide to go to Bitcoin. Because they know, again, they're very well scholared in the ways that government can debase them and can continue to debase their currency in the long term, right? And if people really need to make the decision, ultimately, of course, I'm exaggerating because there's still a lot of education to do, but to those that know at least a little bit, they'll move 100% to Bitcoin. There's no question asked. Mm-hmm. So when they go to the same conclusions on altcoins, say, yeah, I bought Bitcoin, now I need to buy Ethereum, I need to buy, whatever it is, Litecoin, whatever is the next altcoin, or even meme coins, or whatever it is, right? We just tell them the same thing. It's like, listen, this is not diversification, it's worsification, because you're going to end up with one asset that it's going to perform and the others are not going to perform. And you don't need to do much. Just go back, right? Go back in time, and that's exactly what has happened, right? Bitcoin has had has captured this, has been a majority or larger market cap and with high dominance in this market for a long period of time. And in the meantime, thousands and thousands of coins, all of them came with new features, with different things that were supposed to be better than Bitcoin. They all gradually disappeared and ended up, not only underperforming, but in many of these cases, losing everything, right? We point to Ethereum and we point to the coins that, are still around. But the reality is that for every Ethereum that it's out there, there are 1,000, 10,000s of them that completely vanished and disappeared, overnight, where there's not even price anymore. If you bought some of these coins, you're gone. You lost all your assets. We did some analysis on this. You helped me on that as well. It's a little outdated because it's a year or so late ago, but it only got worse, right? But we look at remember correctly, like 8,000 altcoins. Vast majority, if you look at how much you lost, if you invested in the whole basket of altcoins compared to Bitcoin, you lost like 90+% or high 90s%, right? A lot of them ended up disappearing. There are only like 40 of them that outperformed Bitcoin. And on average, they only outperformed by 40%, which again, it's not worth the risk, right? You're not going to be able, none of us are going to be able to pick the 40 altcoins that outperform Bitcoin. And by the way, I just glanced at those 40, and the 40s are not 40 anymore. They're like less than 20 already. They're just history.
Really well. Yeah.
Sorry?
Yeah, Bitcoin's been really doing well against the altcoins over the last year or so. And even so, like you brought up like how they perform, but from cycle to cycle, usually you got a couple ones that outperform, but very, very few outperform from like multiple cycles, right? A lot 100%. Of times like a darling or two for that cycle, and then they never reach their prior all-time highs against Bitcoin. So
100%. You look at the first cycle, like at 2014, 2015, right, which were all coins with better features than Bitcoin. They all disappeared with very few exceptions. And then you look at the ICO cycle, all of those coins. There's so many coins that, people said, oh, NEO, whatever it was, right? Like thousands of them. Oh, this is going to be the new Bitcoin. It's much better than Bitcoin. And I had people arguing with me, the time and time again, say, no, you don't know what you're talking about, right? Bitcoin is slow. Bitcoin is not going to scale. Bitcoin has this issue or that issue. But they're all forgetting a few things. The first one is what I mentioned, that at the end of the day, right, this is a winner takes all. And I'll tell you more. Think about fundamentals, right? So give one step back and think about another thing people miss. By definition, any of these altcoins that are coming out there, they're coming with all these new great features, right? By definition, they need to be open source. So this is very different than, companies coming in with a new product, coming into a new market and capturing the market and having a competitive advantage. By definition, if let's say tomorrow a new coin comes in with something that is significantly better than Bitcoin, if it is going to compete for store of value, it does necessarily need to have the code 100% open source, 100% open for verification. And then people are just going to look, we as Bitcoiners, let's say it is really something really good, something we haven't thought about that could scale Bitcoin, I don't know, 1,000x overnight with no risk, right, or very little risk, because that's the other thing people don't take into consideration of the risk. But let's just take a hypothetical example that happened. Code is open source, right? If it is that good, if it is that obvious that it's a good feature, it very, very quickly somebody's going to submit a PR to the Bitcoin core code, and it's going to be upgraded. And I'm going to be upgrading my node. You're going to be upgrading your node, and then Bitcoin is going to have that feature as well, right? There's no competitive advantage for these coins. Just the opposite. Bitcoin already has the network effects, which it's a challenge for any of these other coins to compete with. It's 15 years of adoption, right? Good luck competing with that.
Yeah, absolutely. And like, I just think about like Bitcoin has won in terms of the store of value. I mean, it doesn't really have competition in terms of digital store value, as well as being a decentralized monetary network, specifically proof of work. I mean, when Ethereum moved to proof of stake, I mean, now it's the only one. And so, I mean, that's the kind of moat that I like to see if I'm investing in something. But you brought up the volatility, and I thought you had a really interesting piece actually looking at the volatility in bonds, of how bonds are actually should be considered a risk asset. Oftentimes you hear, the 10-year is considered the risk-free asset in the, traditional finance world. But you kind of broke that down and actually looked into the volatility. And I was even surprised at how volatile the bonds have been. So why don't we break that down? And I want to actually just show something, which is a chart from Charlie Bolelo. If Jacob, you could throw this on the screen. The U.S. aggregate bond index is currently in the longest bear market in history, 45 months, where it's been down. So bonds haven't been doing too well, and you're saying that they're actually extremely volatile. So let's break into that.
Yeah, the result of what you just shown is something that we saw this week, which is they're like, if you look at the banks, right, pretty much they're like, I think 60 plus banks are insolvent right now, according to the FDIC. And if you look at the unrealized losses of these banks, they're like, $500 billion in unrealized losses, exactly because of what you just shown. I think when I think about volatility in bonds, right, the first one is an obvious one, which is just price volatility. Let's go back to basics, right? A bond, at the end of the day, it's nothing more than a cash flow stream. So you're going to pay, let's say, $100 today for a 20-year treasury, and then you're going to get a coupon every quarter or every year, right? If you want to make this simpler. And then at the end of the period, you get, so in 20 years time, you get your principal back. And then in the meantime, you just got like $5 every year, for example. Let's say it's a 5%, 20-year bond. So every year you're going to get, just make this simpler, you're going to get $5, right? And then at the end, all the way in 20 years, you get your principal back. Now, when you're thinking about, your money in time, right, you need to discount it. And the discount rate is the current rate in bonds. So let's say you did that bond, that 20-year bond, you bought it today, right? So it's going to give you 5% every year. Not a bad rate, right? You're going to get 5% every single year out of that 20-year bond. But what happened is tomorrow we wake up and, let's say inflation numbers are significantly higher than expected, right? And rates have to go up, right? Because otherwise, in real terms, things are just not going to close out, and rates go to 10%. Exaggerating a little bit, but just to prove the point. So what you'll see is that overnight, right? So this happened overnight, just for an example. That's 20-year bond, right? That rates going from 5% to 10%. The price overnight went from 100 to a little bit less than 60. So it's around like 57 or something like that. So overnight, you almost lost half of your assets because of, a bump in interest rates. And these moves happen, right? We see these kind of moves happening, and they're going to happen more and more because we also see volatility not only in price, right? But we also see a lot of volatility in policy. The policy, it's uncertain. The policy changes a lot. We live in a world that is uncertainty, even in the number. Even the past is uncertain today, right? Because if you look at the CPI numbers, how can you make sure that they are not right? We know they're not the right numbers. No. So I would say that in economic statistics, today even the past is uncertain, right? But just going back to the example and giving and I put this on the thread, right? I picked walking through, what the numbers really are. So I picked 5 ETFs who were very well-known bond ETFs, very diversified. So each of them has, hundreds, thousands of different individual bonds in them, right? So this would be as a diversified in terms of exposure bond portfolio that you can get. And then one of them, for example, is like 20-year treasury, TLT, right? It's a very well-used ETF for people that want to get long duration treasury ETF exposure. TLT, for example, has a historical volatility of 15%. The S&P is close to 17%. So 20-year bonds have as much volatility as equities. Wow. Very few bond investors realize that, right? You would see, with the conversations we're having with pension funds, for example, pension funds wouldn't blink if we told them, oh no, you're just gonna buy a portfolio of 20-year treasuries, and that's what you're gonna have. They're gonna say, yeah, it's super safe. I don't. And the problem is that it's banks the same thing, right? This is how they allocate a lot of their assets, and this goes back to what I mentioned in the beginning. This is the reason why we're seeing so many unrealized losses in bond portfolios across, although we talk about pension funds, we talk about, banks, but this is happening across the board. It's happening with family offices. It's happening with any institutional investor that has had a very long time horizon. And the main reason for that, just to close up, is it's monetary policy instability and unpredictability, right? There's another chart included there, which is basically showing where Fed funds are and where Fed fund futures were in the past. And if you look like 5 years ago, 10 years, or 6 years ago, 7 years ago, and where markets were expecting rates to go each of these periods, never markets predict that you're going to have discontinuity in that rate. Whenever rates go up, rates are going to go up, which means that investors, the Fed, by keeping interest rates artificially low for a long period of time, they are to blame to this problem, because investors got really accustomed to low interest rates. How many times we heard, we're not even thinking about increasing interest rates, and here we are, interest rates are much higher than they are. And right now, they're not even thinking about cutting rates. And guess what? Who knows what's going to happen? Imagine if the Fed had the source code that was open source, that could verify, and we knew exactly, how many dollars are in circulation, how many dollars will be in circulation, 5 years, 10 years, 15 years, 20 years, 100 years from now. I think my point is that would be a much better world than the world we live in. Unpredictability. People should be discounting the unpredictability that they have in the current system, and then putting a premium on predictability, right? So Bitcoin is not a volatile asset. The Fed funds and interest rate policy and this crazy world that we live in, that is the volatile world, right? At the end of the day.
Yeah, well said. A premium on predictability. I like that. Yeah, that Fed fund futures chart is so crazy, where it's like looking at the different predictions and they're all completely off. I mean, even like going into this year, the whole market thought there's going to be like massive rate cuts by now. I think like 2 or 3, and here we are. It's almost impossible to predict what they're going to do.
Sam, by definition, the Fed, they plan this. They don't want to leak any information of what they're going to do to the market. Should be just the opposite, right? They should be fully transparent and say, listen, this is what we're thinking about, and rates are going to be X, right? So this tells you that either they don't know what they're going to do, right? Or they're not being transparent for other reasons. None of those are good. And I would rather have a difference. And I tell people all the time, imagine we started with a Bitcoin standard, right? We had a Bitcoin standard already, and we were in hyper Bitcoinization. And then all of a sudden, a group of people approached and said, listen, we know better. We are, the best economists in the planet. And, we're going to know better than this model that you guys have, that it's super predictable. Let's change the code on all the nodes running, so that now, instead of, we're going to vote, right? And it's just going to be us, this small group of people that, by the way, we're not elected. We're just very good, right? That would never fly. It's absurd to think about that, right? So how come people don't think that going the other way, going the other way should be simple, right? We're going to a better world. We're not going to a worse world, right? By any measure that you look at.
Yeah, and I was thinking about, I think in the summer of 2022, it's when they were saying like, we're not even thinking about cutting rates. And then these banks were like, okay, we're going to buy all these bonds. They said they're not going to cut rates. That's when they actually gave some guidance. And then of course they went on like the sharpest hiking cycle in recent memory right after.
Surprise.
Surprise. You bought them.
Yeah, that South Park has this very, very, I put this on Twitter as well a while back. Very good. Like, South Park is brilliant, but they had this after bailouts, right? During the financial crisis, they had this cartoon coming in showing how the Fed, in their view, made the prediction. It's basically they cut the head of a chicken, put on a big board, right? And the chicken just lands and like bailout, right? So this is exactly how I think about Fed meetings, right? They sit in this room. It's like they cut the head of the chicken, and it's like, oh, 50 bips up, 50 bips down, right?
Exactly. Yeah, and like I look at long-term inflation expectations, they're still like around like I don't know 2.5% maybe like the 10-year. I'm just like that seems extremely mispriced to me still in the market. Like I'm like how is that even possible?
Yeah,
But
100%.
yeah, and I look at we talk about bonds. Let's talk about the pension fund because you guys had that the fellow from the Wisconsin pension fund on the Nakamoto Gauntlet. I don't know about a year ago, and then here we are, and they became the first public pension fund to disclose that they have exposure to Bitcoin now. And so, what are your reactions from that? I mean, are you celebrating over here? I feel like you guys played a little bit of a role.
Yeah, I don't know about that. But let's just recap. Let me tell you what happened. So this was about September of last year. I'm actually going to pull the numbers here because they're pretty cool to see. But this was September of last year. Before that, after I launched Nakamoto Portfolio, right, which is this tool that people can go in, can put their portfolios in, and can create simulations around Bitcoin allocations to their portfolio. Dom Bay reached out to me and was like, man, this is awesome. I wish, there was something like this when I had the discussions of putting Bitcoin in the balance sheet of the firefighters pension fund. We should think about, going out and showing this to other pension funds out there. We get their portfolio, we analyze their portfolio, and, they come in the show, and then we'll give them like free advice around how to think about Bitcoin as an asset allocation position. And of course, none of them wanted to take the call. So, which was not surprising. So I said, let's do something different. We'll do the show. We'll pick each show. We're going to pick one of these pension funds, right? And we're going to look at their portfolio as it is. We'll bring hosts in. We'll discuss, first of all, why Bitcoin is an important asset class when you're thinking about pensioners, when you're thinking about long-term store of value for all the things that we mentioned, right? Why, when you think about storing assets in the long term, they should fundamentally think about having something like the same way they think about inflation protected assets, they should think about Bitcoin. So we did the first show back in June of last year. So yeah, about a year ago, which was with the Ontario's Teachers Pension Fund. And then the second show we did, which was in September, was about the Wisconsin Retirement Fund. And the reason why we picked Wisconsin, first of all, there were some people that we knew that were very close to the Wisconsin Fund that we brought to the show. But also when we looked at how they were structured and their asset allocation and how they were thinking about their pensioners in the long term and how to fix it to really allocate to the portfolio, they were one of the best funds in the US by far. Their investment policies were very well described. Their reports are very well put together. So said, well, if these guys don't have Bitcoin, right, nobody else is going to have, because they get it. They understand how to think about this allocation. So
they're overfunded.
Yeah, exactly. So they're overfunded, which is that's yeah, you're right. That's the biggest difference from everybody else, right? They are overfunded. So that says everything you want to know about them. And I was very happy to see that their announcement recently. But just going back, when we finish this show, we usually suggest a hypothetical allocation. And being realistic, because in most of these cases, it doesn't make any sense to get to one of these pensions and say, yeah, you should have 20% of your portfolio in Bitcoin. Even if I think that's the right approach, that's not how you start, right? First of all, you have to let them understand how Bitcoin, just as a pure asset, fits in their portfolio. Then you go into the fundamentals. You suggest a very small allocation. They get into a small allocation. They start to understand it a little bit better. They talk to their boards. They change their investment policies, right? And then that naturally grows the same way that it did with all of us, right? The first time each of us bought Bitcoin, we didn't buy our whole, portfolio in Bitcoin. We bought a little bit. We understand a little bit better, right? Then we thought we knew everything, that we understood that we didn't know anything, and you keep learning. It's the same way, I think, with these pensions. But we suggested 2% allocation to the portfolio when Bitcoin was at $25,000. So that's 2% allocation if they haven't rebalanced. That by itself would have been close to 5% now. So That shows another thing, which is, you don't need a huge. I prefer these investors to have a smaller allocation and not rebalance than have a very high allocation, rebalance, and also risk getting out at the wrong times. The same way that it's the same reason why I suggested to, my dad, who is semi-retired, much older, to not buy a lot of Bitcoin, because, I know that if it goes down in a cycle, it goes down 70, 80%, he's not going to be in a good situation. He's probably going to sell, right? He's probably going to sell even before that, because
Yep.
again, it doesn't fit in his profile. So the same way we started, we tend to start small and then let it grow through time. But yeah, bottom line, it's really good to see. We are seeing the number of conversations we're having with institutions is just crazy. Like everybody's now thinking about an asset. Even people that, in the past have told me, there's a CIO, I can't disclose, but there's a CIO from a very large bank that I know very well, that for many years have told me, you're crazy. Bitcoin is never going to go anywhere. Governments are going to ban it, right? All those things. I don't understand it. I don't get it. That just a few weeks ago called me and said, and this is very hard for a Wall Streeter to do. Like, most of the times this is not the humble type, right? She told me, she's like, I was wrong. My clients want to talk about this. I need to understand this. I've seen what you've done in terms of asset allocation, analytics. Help me out, think about this, right? So these conversations are happening, and they were not happening for many years. Like in my situation, I didn't even talk about Bitcoin to many of my colleagues, because I knew the reaction, right? The reaction would be exactly what I just told you. Like people didn't want to talk about it, they didn't want to listen. So there's a sea of change, I think, in terms of at least people are starting to pay attention to this. And I tell them all the same thing. I say, listen, right now you're in a position that if you don't really understand Bitcoin, if you don't really understand how it could fit in a portfolio, how it could fit in an asset allocation, you go through the process. You can get to the end of the process and decide that, listen, this doesn't fit in my portfolio for whatever reason, right? But you definitely need to go through the process, because if you're not doing that, in my view, you're breaching the fiduciary duty to investors, particularly when you're a pension fund, when you're talking about an asset that, has the potential to be the best store of value that was ever invented in the long term. So even if that's with a very small probability of happening, not analyzing it, it's a huge disservice to the constituents.
Yeah, and I feel like we're going to get into the game theory here now too at the pension fund level, right? You got arguably one of the best managed pension funds kind of making the leap here. Just looking at their funding ratio that we talked about, I mean, there's a lot of factors that go into that, but you got to think that pensions with higher funding ratios tend to be better managed. I think that's kind of a fair assumption. And now you're going to have all these other public pension funds looking at it. I'm wondering if I could get your opinion on like what kind of pension funds will you think go into Bitcoin? Will it be the well-funded ones that have like longer time horizons, or do you think it will be these underfunded pensions that are desperate to find, higher returns on new investments because they want to bridge that gap between assets and liabilities because they're underfunded? Which ones do you think are likely to kind of get into Bitcoin after Wisconsin?
I think it has a little bit less to do with if they are underfunded or not. Of course, the underfunded ones are the ones that should be thinking about this immediately. I just again this is not theoretical; it's documented. It's the Nakamoto portfolio. Like the show is recorded; people can watch it. Like we don't like if they had followed, if the Wisconsin had made an allocation a year ago or less than a year ago in September of last year, that 2% allocation to Bitcoin would have become a 5% allocation to the portfolio. These are billions and billions of dollars that could be beneficial to the pensioners, right? I think the ones that are going to adopt earlier are the ones that have CIOs that are approaching this with a little bit more of an open mind, that are really doing the work, right? It's proof of work as well, right? They need to sit down. It doesn't take much. Just try to look at it, and it's what I always start these conversations like. put aside all the things you think you know about Bitcoin and just approach this as any other asset class you would. Think about this just being a hedge fund manager, a private equity fund, a venture capital fund, right? An illiquid asset that you would invest in. When you start with that lens, everything that else that you get in Bitcoin, it's upside from there. Because this is going to be like a manager, but it has 24/7 transparency, liquidity, the whole product protocol and the investment theory behind it. It's open source. You can see what it is. But if you just on an investment perspective, you can get around it and see that it already fits in a portfolio. Then when we go into fundamentals, then it will only make even more sense, right? So I think the ones that are doing this work, that are starting to sit down and say, okay, here's what it is. And with the ETF, it helps a ton, right? I think I think there was legitimate concerns around custody and how to do it. I went through like a couple of conversations last year, for example, that we got all the way to the end. So they determined, okay, we understand the assets, we understand the allocation, we're bought into that. They had the conversations, they thought about changing the investment policy. Through the process of changing the investment policy, the natural question is, okay, so how do I buy this? How do I get access to it? And then you tell them, like, listen, we're going to set up a custody account for you, right? It's going to be with one of these custodians. And there's a very good process. I think there are very good custodians out there, right? Because they can't hold their keys. I mean, these guys, for us individuals, the best thing to do is to hold our keys. That's what we should do, right? But for pensions, it's again, we're trying to make things simpler and closer to what they're doing, right? This is already like, it's not the custodians you have, it's another custodian. By the way, let's not do that. You're actually going to hold your own keys. There's no custodian. So you have to walk before you run. And when you got to the point of them really pulling the trigger, they just kept delaying, and didn't, because I could see they couldn't get across, really doing due diligence in another custodian, really understanding that, putting that in. These are guys who are doing 1,000 different things also, right? They're going to have to stop their process and start something new. With the ETF, with all the flaws that it has, it's literally telling them, like, listen, you understood the asset, right? It's whole process, it's a journey, right? So first of all, we did all the things I mentioned, right? Now I think we did one step more. When we got to that point, like, it's okay, how do I allocate? I tell them, buy the ETF, get access to the ETF, right? So the next point after that is, okay, they bought the ETF, they bought into Bitcoin. Now they're aligned with the network, right? They understand what Bitcoin is. This is going to lead them to understand a little bit better. And then on the side, we start having a conversation about the different ways they can actually hold their assets and have self-custody, and why that's important, why that's a whole set of new features, right? They didn't even think about, right? Because before, they don't think about the risks that they have with traditional custodians. They put the money in Fidelity, and for them, it's like, this is as safe as it could be. Nothing's never going to happen, right? That try asking the question. This is exactly what you're going to list. Like, nothing's going to happen ever with Fidelity as a custodian. The system is always going to be there, right? Again, it's low probability, but it is a risk that should be. The risk of that is not zero. I'll tell you that, right? Is it high? No, it's very, very low, but it's definitely not zero. So yeah, that's where the conversations are heading.
Yeah, I mean, all that makes sense. It's just funny with Biden vetoing SAB 121. It's like they're preventing these pension funds from using highly regulated custodians like the State Streets and BNY Mellon, who are building out their own digital asset custodians. So, I mean, yeah, you have Fidelity and, what, Coinbase and other like institutional grade custody solutions for these pension funds when they could have others. But apparently Biden doesn't want that.
It's a whole broken system, Sam, from top to bottom.
Let's pivot to what you focus a lot of your time on, which is Swan mining. How are things been post halving? Just throwing it out there, everyone's talking about how halving's going to impact the mining industry, and here we are. And, we saw a little bit drop in hash rate, I would say, which I think is to be expected. But any big takeaways or surprises post halving with your experience running a large, mining operation?
Yeah. And this is where I've been spending most of my time lately. Mining is super exciting, right? I think if you look in terms of the technology, the infrastructure, and just on the protocol level, it's super interesting to see the different things that are happening. Post-halving, I mean, we've been thinking about it's back to what we were talking about. It's predictable. We know nobody could say they were surprised by the halving. Everybody knew the halving was coming. We know another one is coming, and I think the miners that were doing this right, they've been planning about this for a while. We're already planning for the next halving and the one after that, and I think that's the way everybody should be thinking about in mining. And yeah, hash rate has stabilized, slightly went down on the network level. If you actually look at the longer term chart, it's the first time in a while that we've actually seen that happening. And I think there are a combination of things that are coming into play here. The first one, it's the obvious one, it's just the halving. There are a lot of people that were in the margin mining with equipments that were less efficient, and they turn it off. And because of that, again, difficulty on the overall network goes down a little bit. But there's a bigger thing happening that we're starting to see, which is competition from AI. So look at the public companies, a lot of them announcing new plans to move into AI. And for us as Bitcoin miners, I look at that and I kind of like it because it's going to be reflected in lower difficulty again hopefully, and less competition. But who knows, right? I mean, hash rate continues to go up, has been going up. If you get the newer generation of miners, right, get S21s, T21s, and they're extremely profitable machines. Mining is still a very profitable business, right? Even after paying, everything off, you're talking about margins that are like in the high 20s, low 30s, much better than most of the industries out there. It is a capital intensive business. As I've been saying from the beginning when we started mining, I think capital is in the core of what you do in mining. What really, if you look at the companies that went under through the last cycle, what broke them, we all look a lot into hash rate, efficiency of machines, difficulty in having transaction fees, all of those things. But most of the companies that went under, they went under because they had the wrong capital structure in place. They either were way too leveraged, right, or they had very expensive debt on their balance sheet, or very short maturity debt that they needed to pay out. These are the things that made most of these companies go under. So planning and having, I think, the right capital structure is key for miners in the long term, right? And this is when you think about, there's going to be, I think, some differences probably looking forward between private miners and public miners. Public miners right now, they're incentivized to go to the AI route. I don't blame any of them. If I was CFO, CEO of one of those companies, I'd be doing exactly the same thing. You get a significant higher multiple to go into AI. There's a lot of capital that is thrown into you to build the infrastructure that you're going to need. So why not do it, right? They already have access to infrastructure. So and then their valuations just, significantly go up, and their stock options significantly go up. So I think private companies, this is exactly where they're going to continue to go. Public companies, private companies, I think they're different beasts, and there's going to be a little bit of everything. And who knows? I actually think this may be an opportunity for us as continue to be Bitcoin miners to pick up some assets and start, seeing hopefully some difficulty coming up. I say hopefully because every time that anybody predicted that difficulty was going to stabilize or go down, they're always wrong, right? You think Bitcoin, his number go up, just draw a chart of a network difficulty. That is the true number go up.
Yeah. Well, I mean, you brought up, last cycle, these mining organizations that went under. One of them was Core Scientific, that went bankrupt. They came out of bankruptcy, and that was one of the news, is that they had made a deal with CoreWeave, 12-year deal to provide infrastructure for use cases for AI and machine learning. I think some of these miners are trying to diversify their revenue streams and things like that. And one of the maybe consequences of this that some miners have been talking about is AI now competing with Bitcoin miners, with electricity, for basically electricity. And so do you think that will have an impact on these miners in terms of their electricity costs now that there's another buyer in the market that seems to be growing pretty exponentially, as well as very well funded? What are your thoughts on that?
Yeah, there's some of that. I think in some specific regions, right? There are definitely some data centers. We've seen it, like, in very well connected areas with plenty access of water, that you had Bitcoin miners there, and then they're not going to compete, right? Because somebody's going to come in and pay more and buy them out, and it would still be profitable for the Bitcoin miners to be sitting there. But if you're the owner of this facility and you can just capitalize and sell your facility and get an AI company there, they should do it. It makes a lot of sense. The beautiful thing about Bitcoin mining is that it's much more flexible than the HPC, right? Literally, you can do Bitcoin mining in the middle of the desert with a Starlink connection, and you'll be fine, right? Is it ideal? Probably not, but you could do it. So it's much more resilient. I think it's much more flexible. It can go to different places where AI cannot go and will not go at the end of the day. Also, there's like the way the infrastructure is set up, it's very, very different. Like there are huge gains of scale in AI. So, if you build a small facility in AI compared to a huge facility, you're much better off building a huge facility if you have the capital, right? While in Bitcoin mining, I can just build 10 megawatt sites, and the difference between that and having 100 megawatt site, yeah, of course there are some, but it's not nearly as close as the losses that you would have of having like 10 different AI sites at the end of the day. But they're very different beasts. And I think the other thing, long term, there are going to be things for both industries to do together, because AI doesn't, they're going to be idle power, energy, and for AI, right? It's not like they're consuming 100% every time. At peak, you're going to have more demand. You're going to need more power. So there are a lot of these companies already talking about, having hybrid mining facilities where most of the time they're in HPC, and then when they have low demand, they switch to Bitcoin mining. I think that's something that, again, Bitcoin is going to fill in different sectors, not only the AI sector, right? That happens with flaring. That happens, I think, in excess hydropower, right? Bitcoin mining is like the same way we talk about the honey badger. For mining is the same thing, right? It's very resilient. It will go anywhere. It's this thing that you can mine all the way from a very old machine to very new, highly efficient immersion, two-phase immersion machines, and there's everything in between, right? That you will do. So Bitcoin is going to continue to take the margins of the system. So excess capacity mining energy facilities that are just sitting there, that have stranded energy that cannot be deployed to other places. Still a lot of that available both for AI and Bitcoin, right? So I'm not worried about that in the short term. I think there is going to be a shakeup. I think there are going to be moves. We're seeing a lot of that already. But in a sense, that's actually an opportunity.
Yeah. And competition, not necessarily always a bad thing. It kind of forces innovation and more creative ways to find even, maybe stranded resources that haven't even been tapped yet. And so that buyer of last resort, energy buyer of last resort for Bitcoin miners, and the flexibility, I agree with you. I think that's what's going to shine over time with Bitcoin miners. So what kind of things, just like final question here, just maybe what gets you excited for the next year? Like, what are you working on, or you look out into the market? What kind of things kind of gets you excited looking forward a little bit?
Yeah. So mining is definitely top of that list, because that's what I've been doing a lot around. But I don't know. There are many things that I continue to get excited in Bitcoin. The more I've been doing this for a while, and the more I look into it, the more there's always something new to think about, right? And there's always a new angle to think about different things. And then you'd listen to one of your podcasts, and then you'd listen to other things, and you're like, oh, that's a different way to think about that I haven't thought about, right? And it just opens, like you're opening a whole new door to think about the different things, right? And that's the exciting thing about Bitcoin. So if you ask me, is there like a specific thing that will excite me? I don't think so, but there are definitely going to be surprising things. I'll give you one example. And this is not very well structured because I'm still thinking about this, but with the whole conversation around ossification now, right? And should Bitcoin be ossified or not? I'm going back a lot to something that I thought right in the beginning as I started my Bitcoin journey, which is tracing parallels between game theory and Bitcoin. Because at the core of Bitcoin, if you think about it, it's almost crazy that Bitcoin works, right? It's a fully decentralized network, all these nodes everywhere. You don't have anybody telling other people what to do, and it works, right? And I think the whole reason why it works is exactly because it has a lot of game theory on its core. Game theory, it's a study of a strategy, decision making, that the outcome, right, for each participant, it's going to depend on the actions of the others, and you end up, in some cases in the optimal situations, even though you don't have everybody's trying to make actions in their own self-interest, right? And when I think about ossification, a lot of it I think about in terms of Nash equilibrium, right? And I think there are things in Bitcoin. They're already in Nash equilibrium, and they're always going to be in Nash equilibrium, and you can't change that, right? And just to say, Nash equilibrium is something that, an action of a player, if they none of the players, they can change their strategy while the other players keep their strategies unchanged, right? So if given that everybody else is doing, what I'm doing right now, it's the optimal outcome. And when we think about, there are a few things in Bitcoin that I think are already at Nash equilibrium and they're not going to change, right? And some are obvious, like proof of work, for example. I think proof of work, it's already pretty much a Nash equilibrium, right? Miners have invested heavily in hardware, right? Their energy costs, changing that, there's huge costs, right? So the optimal strategy at the end of the day here, I think it's already what we have. Same thing with the 21 million Bitcoin, right? That's also in Nash equilibrium, and that's going to be very hard to change. I think where we start to have confusion and we start thinking about is there are things that are still, I would say, almost like in the prisoner's dilemma part, where they're not in Nash equilibrium, and there are changes that could happen, and people are still thinking about what is the best place to get it in a Nash equilibrium. Eventually, we are going to get, I think, to a solution that will get us closer and closer to Nash equilibrium, and then ossification never really happens, because if there's a big change, as I said in the beginning, that will happen, even the Nash equilibrium will change. But for these things, they're getting closer and closer to Nash equilibrium, and they're at Nash equilibrium. It's just much harder for them to change, right? And the ones that I think are, excite me to understand better, and I've been trying to, and I haven't come to a conclusion in many of these, is, the solutions for scalability in Bitcoin, the transaction fee market, right? The process for upgrades and governance. I think these are things that are still not in Nash equilibrium. They are heading towards Nash equilibrium. I think some of these, we're getting closer and closer. But I think these are the things that I've been thinking about, and I think for the next year, there's going to be a lot of discussion around this, right?
Mm-hmm. That sounds like an article, Nash equilibrium. Maybe your next article. Yeah. Well, thanks for coming on the show. I mean, if people want to read some of your articles, you can find that on the Swan Signal blog. I know you wrote one recently on why you thought, the risk of government bans are basically very small nowadays. So you can check out that if you haven't read that, as well as follow Alpha Zeta. Follow him on X. He's still critically underfollowed, I would say. So if you're listening, you don't follow Rapha here, you're doing it wrong, my friend. So go check out Alpha Zeta. Any closing comments at all, Rapha?
No, I think we covered a good amount, as you said. Reach out to me at Twitter if you have, or X if you have any questions, and be an exciting year.
Well, thanks for coming on. We're gonna have you back on soon. Always appreciate hearing your insights, and have a great rest of your day, Rapha.
You too. Thanks, Sam.
I hope you guys enjoyed that one. I always love talking to Rapha. I get the privilege of doing it at Swan almost on a daily basis, but you guys get to hear some of his insights here today, and it's why he's one of the most brilliant minds, I would say, in the space today. Head of Swan Mining, and we're kind of building that out at an impressive pace, I would say. So congrats to the team who is part of Swan Mining. I hope you enjoyed the show. You can comment, you can like, you can subscribe to the YouTube channel if you haven't already. That always helps us get the Bitcoin message out to a wider audience. So we appreciate your support. Let me know what you thought. And also, right now, I have to remind you guys that at Swan, the next $10,000, there's no fees when you stack sats. So if you haven't bought Bitcoin through us, the first 10,000 is no fees. And if you have been stacking with us, first off, thank you. And your next 10,000 are no fees. So now's a great time to stack some sats as cheaply as possible. So go check it out, swan.com. And so next week, got another great show. We got Harry Sudek on from Grid. He's a smart guy if you haven't heard Harry talk. So looking forward to interviewing him. So make sure you tune in next week for that. And thank you so much once again for listening. I'm Sam Callahan, and I am out. Peace.